This is the Asia Trade. I'm Shery in Tokyo.
And I'm Haidi, Stroud-Watts in Sydney. The top stories this hour. Asian stocks are set for a positive start after tech drives Wall Street to its 25th record high of the year. Goldman Sachs seeing a wall of money fueling further US equity gains. Nvidia's market value topping $3 trillion, overtaking Apple as the AI frenzy keeps fizzing. And Narendra Modi secures coalition support, handing him a third term as India's Prime Minister despite his election setback.
Haidi, developments around the India elections still topping our agenda, and we have now seen him being able to form that government, but the caveat being that he hasn't had to share power since taking office in 2014, so this might be a more challenging tenure for him.
Yeah, and challenges ahead in terms of the broader geopolitical landscape, right? We heard from Ray Dalio talking about his idea of economic warfare as being the top risk. And in fact, he says when it comes to internal conflicts, for example, what happens after the US election result in November, perhaps not being given as much attention to by investors as they should. Take a listen.
There's a great risk of economic sanctions, an exchange of economic sanctions that would be really terrible for the world. So there's risks behind that. At the same time, Chinese assets are very attractively priced, and we've done very well. Bridgewater has done very well over the last 5 years of operating in there, and so there's certainly effective ways to make investments in China.
And another big risk, of course, being if central banks around the world will be able to really manage that soft landing. The Bank of Canada seems to think so. Canada becoming the first G7 country to cut rates. We're expecting the ECB to follow suit as well on Thursday. And all of this ahead of any moves by the Federal Reserve. And it's really that rate gap differential that we're seeing that's playing into the markets, right? Take a look at the Japanese yen, because we continue to see the downside pressure and yen weakness, which started, remember, yesterday with wage growth data out of Japan pressuring the Japanese yen. But overnight, we had ISM's business activity data strengthening the U.S. dollar. So this is the setup across markets in Asia. Korea away on holidays. But as we mentioned, across Asia, we'll have to keep an eye on those tech stocks, given the rally that we saw overnight in the U.S. session. The Nasdaq 100 really being led higher by NVIDIA and the Magnificent Seven. And remember, we said that NVIDIA really topped Apple. That's the first time that it overtook it in market value since 2002. So we'll be watching how tech stocks across Asia trade today as well, Haidi.
Yeah, and it will sort of peter through to some of the other names, even as we have to acknowledge that NVIDIA, this is the one company that has been the biggest beneficiary of this flood of spending into artificial intelligence. Let's bring our next guest, who's recently leaning more into secular themes like AI. Joining us is Julia Wang, who's the Executive Director and Global Market Strategist at JP Morgan Private Bank. And just taking a look at that $3 trillion club, right, for NVIDIA. When you take a look at, I suppose, the more medium and longer term aspect of how to invest around this theme, is there a bit more visibility as to what the next stages might be and the companies that might benefit?
Sure. Good morning. Thanks for having me. So we've been, I think, firm believers in the AI technology, its ability to have transformational changes on the global economy. Now, as you mentioned, there are definitely stages as to its AI technology as that impacts markets and the economy. So these stages are, we'll separate them into maybe the infrastructure stage, hardware stage, software stage, etc. So I do think that we're still at the early to sort of middle age of this, and where a lot of the beneficiaries for the AI theme are very concentrated in the infrastructure and also increasingly now in the hardware and CapEx spending. We definitely are seeing that in a lot of the corporate data, a lot of the national statistics that countries are leaning into building the hardware necessary for AI. So these are, I think, some of the reasons why stocks that are very obvious in terms of their visibilities of earnings, and just in terms of how much semiconductor they sell. Stocks with such visibilities are increasingly, I think, favored by investors as they think about playing the AI theme. But we do think that as we come into the next year and the year after, there will be greater beneficiaries. And we're already started to see some of that play out. For example, some of the ancillary themes around utilities, around energy spend have recently caught investor attention. But we think there's more to come in the coming years. This is not a short-term story. It's a multi-year story. And we think that we're still at the relative early stage of that. And the market are, at this point in time, choosing to reward companies with more semiconductor exposures.
What are the best plays within Asia to do that, particularly if you're maybe looking for more value?
Yeah, so we think that Asia is very well placed because it has such an essential position on the hardware aspect, semiconductor aspect of these AI build-outs. So, one of our favorite market, of course, is Japan. Japan has, a very compelling comparative advantage, or even you can say virtual monopoly positions in some of those equipment and materials that you have to use for semiconductor build-out. And also South Korea, Taiwan. So Asia is really quite well placed in the hardware aspects, and some of these companies haven't necessarily, run up as much in terms of their valuation or in terms of their stock price. So we do think that combined with the more favorable domestic economic backdrop in economies such as Japan, we do think that these stocks do have more near-term runway as well as medium to longer-term potential.
So that's the sector that you're actually focusing on, because when it comes to Japan, we have seen a lot of optimism across foreign investors, but at the same time, we're not seeing the rebound in domestic consumption that many had hoped for.
Yeah, so I think historically speaking, Japan has always been a cyclical market, which has been very sensitive to global demand. So I think a natural starting point for many investors when they look at Japan is to say, where's global PMI? Where's the global manufacturing cycle? Where are we in that cycle? And of course, this cycle is different because we have AI. So these are the things that amplify, in our view, Japan's ability to benefit from this cyclical upturn in the manufacturing sector. But there's no surprise that this is an area the investor will start with when they look at Japan. And, we have those favorable tailwinds from easy monetary policy from the Bank of Japan, from easy, attractive, or you can say cheap valuation of the yen. And these, again, also increase the benefit to Japanese exporters or manufacturers. But we do think that, this time, what's different this time around is that you seem to be able to detect a greater transmission of corporate profits into wage. And that is essential for unlocking some of the consumption or pushing for the consumption recovery in Japan, which we still do think will come in the second half of the year. And that's another theme we like in Japan.
Consumption recovery also an issue across China, right? Especially with what's going on in the property sector. Is that sort of the same way that you would invest in the world's second largest economy, more tech focused, given how cheap those stocks are right now?
So we do think that China is sort of a different issue in terms of where they are in the economic cycle, but also I think just the number of policy challenges that still we need to go through. So, technology, for example, is an area that I think has been relatively easier to like for investors. We do have a bit more earning visibilities, and the earnings haven't been that bad. So I think that's an area where, if you are of a slightly longer-term horizon, that's an area that we do recommend in the Chinese equity space. Consumption, I think, it will take longer to recover because there are just multiple headwinds that we need to sort through before we can see a firmer recovery of household confidence.
There's a couple of risks that you flagged as a yield spread in the US, the possibility that we see a more resilient US dollar. Does that happen even if the Fed does ease this year? And does that have implications for China, for example, but across the rest of Asia EM?
Yeah, so we have been of the view that the U.S. economy will most likely see a soft landing in this cycle, and the definition of that is the growth will slow, but not to recessionary levels. It will just normalize from a very elevated level to a more normal level. like in past business cycles. At the same time, there are some structural factors that may cause inflation to stay at around 2%, or even above 2% in the next 1 or 2 years, rather than sliding below 2% in a very disinflationary way. So this is why this cycle, we think, will look different for developed markets, because interest rate will be higher than they were pre-pandemic, and the dollar will likely be stronger than they were pre-pandemic. So what that means is that if you compare developed market, particularly the United States versus Asia economies, our interest rate differentials will likely stay somewhat larger. And that is a source of a weakness for currency like the yen, which are very sensitive to interest rate differentials and all those carry trades that come with it. And I think it's also a little bit of a persistent tightening pressure when it comes to financial conditions. But it's not something that we think will be hugely disruptive, as long as there's positive domestic economic growth or policy that can offset it. And countries find different ways to do that.
So given the uncertainties that you're talking about over rate differentials, not to mention politics as well, we have seen, for example, the global president of SIBO earlier this week talk about perhaps the potential of using options, especially when they're options-based ETFs sometimes for passive investments as well. With already this strong rally that we're seeing in equities, is that perhaps a way to achieve your target price earlier?
Yeah, definitely. So, one of the themes that we're pushing for is strong markets, but in a fragile world, right? So that's essentially, I think, captures the sentiment of many investors at the moment. There's so many tailwinds. AI is obviously something people want to participate in. You don't want to lose out on those big generational shifts in Japan. But at the same time, obviously, there are risks that keep investors worried, at least for the near term. So we do think that options can be a great way to help realize your target price early, buy with building a little bit of protection, downside protection into your portfolios, while you stay participated in the market for those upsides that we think are still to come. So I think it's a great way for investors to introduce a little bit of hedge into their portfolio, but also stay invested.
Julia, I do wonder, given so much attention has been on the unexpected results of the India election and, of course, the investor shock that has played out, what has been your takeaway? And I guess what can we expect, given that this has been such a market darling? Is it going to be difficult to kind of resume that same trajectory for risk assets in India?
So we think that, given that Prime Minister Modi seems to be able to stay on as Prime Minister, there is going to be a large degree of policy continuity there. That said, some of the deregulation and the economic dividends that will come from those deregulations, because it's a coalition government, might take longer than previously expected to materialize. So maybe that will shave or weaken a little bit of the momentum of the Indian market, if some of those dividends had already been priced in, for example, prior to election. But we do think that if you look out to the medium-term horizon, GDP growth in India isn't necessarily dependent on the government. It depends on corporate profits. It depends on how corporates are doing. So at this point in time, there's no very obvious reasons why corporates will do much worse, or trajectory will look very different. So I think from a medium-term perspective, there's no reason to really change the outlook at this point. But from a short-term perspective, I think some of the reform dividend being slower to materialize could weaken the momentum in the near term.
Julia Wang, good to have you with us, global market strategist at JP Morgan Private Bank. And we do have more conversations coming up on the Asia trade, including with guests such as Eli Lilly's Japan President Simon Thompson, as well as Deutsche Bank's APAC CIO. But first, we'll continue those discussions around Narendra Modi. He secured a coalition deal to stay in power after his party's shock rejection by millions of poor Indian voters. The details just ahead. This is Bloomberg.
Take a look at how we saw the recovery in Indian ADRs, and really the question is, I suppose, whether this newfound resilience can be sustained after that big intraday declines that we saw in the previous session. We heard, of course, Indian Prime Minister Narendra Modi winning crucial backing from two key allies to be able to form government and extend that decade into power. But a lot of questions still in terms of the resilience and his very mandate, right? Let's bring in economics reporter Swati Pandey, who's been covering this story in detail. So, Swati, that is the question. He's sort of scraped through with this coalition. Is he a weakened leader now?
He is, and the bigger question also is his ability to work with other coalition partners, because he does not have that experience. In the past, he came to power with a full mandate. It was his party, it was his decision, and now he's having to form an alliance, and he may have to give some concessions. And it's not clear what the other coalition partners have demanded of him. He may have to give them some key ministerial positions, or, we're just not sure, and also not sure about how he goes ahead with forming this government and working in this government with other partners.
How reliable are those partners when it comes to cooperating with the Prime Minister, and what could be some of the key challenges in terms of issues that they want to pursue?
The two key partners, one of them is Nitish Kumar of Janata Dal, the other is Chandrababu Naidu from Telugu Desam Party, and both of these men are known to have fickle political relationships. They move ships or jump ships wherever they see there is better prospects for them. Nitish Kumar, in fact, has changed alliances 4 or 5 times in as many years. So that does show the challenge that Modi has in ensuring that he keeps them to ensure that his government stays in power. And that does add to the challenge of maybe enacting some strong reforms around labor or land laws in India. Business-friendly policies are likely to continue. So I think from stock market perspective, the reaction was really outsized, but analysts do expect that business-friendly policies will continue under this new coalition as well.
The strong personality of Modi was also front and centre in terms of his global partnerships, right, and how he presented India on the world stage. Is that likely to suffer or change with this coalition?
Yes, so it shouldn't change that, because Modi continues to be the Prime Minister. He will continue to be the leader of the country. And some of the global policies that India has had, international policies that India has had, has support from, generally speaking, other alliances and opposition partners as well. So India will continue to keep its relationship with the US, which does look at India as a critical counterweight to China. And India will continue to maintain its strategic independence which it did by not condemning Russia for its invasion against Ukraine or not shunning its oil exports. So we are going to see that continue. So I think from an international perspective, things should not change dramatically from here.
The polls led us in an entirely different direction. What do the actual results tell you in terms of the sentiment on the ground and what this government will need to be very, very mindful of in this next term?
One of the things that Modi did after his 2-year term and this election campaign defined was the pro-Hindu agenda. And it was interesting to see that in Ayodhya, where he did this major Hindu temple inauguration, he really suffered a huge setback there. So that does tell something about the people of the country as well. So that is one thing. The other thing is we saw India's growth story. Everybody had been talking about it, 8% plus growth. A lot of people felt like they were not part of that growth story. We saw rising joblessness, youth unemployment rising, women's participation rate falling in the labor market. We also saw rising inequality, so the rich becoming richer, poor becoming poorer, and the opposition, so 20 opposition parties came together and formed this big alliance, and they really ramped up the rhetoric around these issues where a lot of people felt like they are not being considered. So these were the issues that the BJP probably overlooked, and Modi probably overlooked, and the election results does show that.
Our economics reporter Swati Pandey there with the latest on India, and you can get more analysis on India's election results from today's webinar. Bloomberg's Menika Doshi will be digging into just what went wrong for Prime Minister Modi and the implications for the world's fastest growing major economy. Speakers today include Eurasia Group's Ian Bremer and JP Morgan Securities' Rajiv Batra. More ahead on the Asia Trade. This is Bloomberg.
There are people that depended on a low-rate environment to get exits. And I don't think that low-rate environment's coming back anytime soon. I think rates will probably come down from here, but we are in this environment for some time. I think that's a good thing. Some of the businesses that relied too much on unprofitable growth are going to have challenges getting exits, frankly, at any price, at any time.
Valuation environment has fundamentally changed, and as a result, private equity sponsors are just going to have to hold companies longer, have to grow into those capital structures, are going to need to take on equity to get some refinancings done. And all that means, it's just math, that returns are going to be lower over the next few years.
Investors look at their DPI multiples, how much money has been distributed. So I think there is a backlog of transactions that were supposed to happen in the last 12 to 18 months that have been delayed, but they are coming, and we're seeing that in the pipeline today.
You're seeing deal activity come back, certainly over a lower base from last year. And our view is that that's going to pick up over the course of this year into next year, simply because limited partners in private equity want to see their capital back.
In general, just the need for this type of capital is insatiable.
Bloomberg TV guests at the Super Return International Conference in Berlin. And it's time now for morning calls ahead of the Asia Trading Day. Apollo Global Management says the private equity industry must face up to the reality of lower valuations. Co-president Scott Kleinman says there will be fewer realizations and lower returns on the horizon. He explains private equity firms will eventually have to refinance assets bought up until 2022 at higher rates. Goldman's trading desk sees a wall of money pouring into the stock market in early July. The bank's global markets division managing director Scott Rupner says that may set up a continuing rally in the next quarter and into the second half of the year. He adds that share prices should benefit from strong seasonal trends and rising engagement from retail investors. Haidi.
We've got a little bit of development when it comes to oil price pressures. Saudi Aramco lowering prices for all of its oil to Asia next month. This is the first cut since February. A pricing sheet says flagship Arab light crude will be cut by 50 cents to $2.40 a barrel above the regional benchmark. It comes after some OPEC Plus members, including Saudi Arabia, agreed to gradually roll back voluntary supply cutbacks beginning in October. Taking a look at how that's sort of affecting pricing when it comes to oil, we're actually seeing that advance still continue off that 4-month low. Traders trying to establish that pricing floor after multiple days of declines. We are also seeing industrial metals pretty much coming under pressure there as well. Copper falling through 10,000 after those recent gains, but gold rising, the focus shifting to more US data. This is Bloomberg. This is the Asia Trade, about 30 minutes away from the major market opens. Here are the top stories that you should know. Asian stocks are poised to gain following a tech-fueled rally in the US. The S&P 500 notching its 25th record close this year, with AI poster child Nvidia leading the way after hitting $3 trillion in market value. The Bank of Canada is the first G7 central bank to launch into an easing cycle after lowering its benchmark overnight rate by 25 basis points. The ECB is poised to follow suit later on Thursday, with analysts also pricing in a 0.25 percentage point cut. And Narendra Modi has secured coalition support, handing him a third term as India's Prime Minister despite his election setback. India stocks rebounded yesterday from the post-election rout that have raised almost $400 billion in market value. Well, this is a setup across Asia after, of course, that huge rally driven largely by one stock, by one sector. It is, of course, tech and AI front and centre, and that will be the theme as we get stocks looking like a higher open here in Asia as well. Sydney up by just about 0.5% in futures trading. We're seeing a strong start out of the gates when it comes to trading in Japan as well, Shery.
Yeah, and Eli Lilly, one of those that benefited from the big rally that we saw in the U.S. session as well. Now the stock at a record high. It's among pharma companies benefiting as well from a new wave of obesity drugs, a category Bloomberg Intelligence thinks could reach sales of $80 billion by 2030. Obesity and associated medical issues are on the rise in Japan as well, where Lilly launched its weight loss and diabetes product, Mounjaro, last year. The same drug is sold in the U.S. as Zepbound. Let's discuss the prospects for the business in Japan and globally. Simone Thompson, Representative Director and President of Eli Lilly Japan, joins us in the Tokyo studio now. Great to see you in person.
Thank you.
So basically, Mounjaro right now here in the U.S. is marketed as a diabetes drug, but you have already asked for regulatory approval for the treatment of diabetes or obesity, that is.
Yes, that's correct, Shery. So first of all, we have launched already Mounjaro here in Japan for the treatment of type 2 diabetes. And we also have announced that we have submitted and filed for regulatory approval for obesity disease here in Japan.
Do you have any updates for us, and what are the expectations of demand here?
Yes. Well, first of all, let me say that for type 2 diabetes patients, we see around about 10 million patients here in Japan, and half of them are actually still not achieving the HbA1c levels, which should be below 7%, to make sure that they really don't have any diabetes complication. And that's where currently Mounjaro is helping existing type 2 diabetes patients here in Japan. And that's very exciting. We have seen a very strong uptake. Second, for the obesity side, this is a very complex disease, right? You have excessive fat accumulations in your tissues, and it's really, impairing your health. And this is where actually tirzepatide could be a really good treatment option. And we have seen here in Japan that probably around 30% of men, a little more than 20% of women are actually can be diagnosed as obesity disease because they have a BMI of 25 and higher. So therefore, the prospects are very strong. There's a high unmet need. Unfortunately, there's little treatment. So we're looking forward to providing tirzepatide soon.
Is there that sort of awareness here in Japan, as there is in the West, that obesity is actually a disease? And are you a bit concerned about the government perhaps not being as open to such drugs, given also the very strong diet culture in Asian countries?
Yes, great question, because you are absolutely right. Currently, we still feel like there's a lot of social stigma around that. It's not really recognized from a society standpoint as a disease, but it is. It's a very complex disease, right? Because when you have risk factors, you're at risk of stroke, of cardiovascular disease, of death. So it's very serious, but still I think society believes that obesity is something you can self-manage, right? You can just control yourself. Even we know it has to do with lifestyle, it has to do with genetics, with the environment you're actually living on. So therefore, treatments are very rare currently, so we think, tirzepatide is an important treatment option, but we also, of course, would like to work with the government, with the medical association, to raise public awareness and address this social stigma, which is really debilitating for patients.
You know, with the rising popularity of this drug category to treat obesity and to promote weight loss, there's also concerns about, you know, what happens when you come off it and what are the long-term implications of staying on it, you know, indefinitely, right? Is that something that we're getting more data on?
Absolutely. Well, first of all, as you know, the regulatory submission always requires to have a very compact clinical data package on efficacy and safety. So when we launch these products, receive regulatory approval, Heidi, we have already very, robust safety data. And then, of course, as the product will be used in future, we're generating, of course, more of these data. So far, we have seen a very robust safety profile. We have a very strong efficacy profile for tirzepatide in obesity disease, where we have seen quite significant weight loss, which medically is relevant for these patients to come off this risk implications.
And there's been huge, supply concerns over these drugs as well. In Japan, are you looking to partner with manufacturers at all in terms of having local production?
Yeah, so first of all, you're right. We have seen an unprecedented demand of incretin globally, not just here in Japan. So we're really working hard to address and produce more. We have announced over the last 4 years $18 billion of manufacturing investment. That is the most ambitious manufacturing investment we have done in our 148 years of company history. And so every day we're continue to support and supply more. Here in Japan, when we started last year, we had to control some of the shipments, but we have worked really hard with our partner here also on the ground, Mitsubishi Tanabe, and our manufacturing colleagues, and happy to share that the supply here in Japan is stable and we have lifted these controls.
Biotech and pharmaceutical innovation is huge in Japan, obviously. What are you on the lookout for in terms of identifying, the next most, hopeful medicine for the company?
Yeah, so look, our scientists are really looking into advancing science and therapies. We're operating in a couple of core focus areas, namely oncology, diabetes, obesity, which I spoke about, but also immunology, neurodegeneration, including Alzheimer's, dementia, and pain. So these key focus areas, we're partnering with our scientists. We're, of course, also screening the landscape internationally to see which, new modalities we can actually take on. And as you probably have seen, our pipeline is being regarded as one of the best in the industry. And I think it has to do because we continue to invest into complex diseases like Alzheimer's, dementia, because we have invested $8 billion the last 35 years. We have had multiple clinical trials, a lot of clinical molecules we have tested. Now we have donanemab, which we have submitted for early Alzheimer's disease. And I think that's the path over the last decades which have made us successful, and we will continue on this path.
Donanemab, with the approval, what is the update on that front, and how big of an opportunity is Japan, where, of course, we deal with an aging society?
Yes, so we have announced last year that we have submitted donanemab here also for regulatory approval. So we're working with the regulators as we speak. The market here, of course, there's a huge unmet need, Shery, because currently next year the MHLW estimates that we will have 6.5 to 7 million patients here in Japan with Alzheimer's dementia. So there's a huge unmet need. And, of course, we hope that with donanemab we can help many of these patients to, show decline of their progression of their disease.
Simone Thompson, really good to have you here in the Tokyo studio with us with an update of everything that Lilly is doing when it comes to all of those new drug developments. She's the director and president of Eli Lilly Japan. And coming up, Hewlett-Packard Enterprise shares are trading at record highs after the firm reported better than expected revenue fueled by the AI boom. Our interview with their CEO, Antonio Neri, is next. This is Bloomberg.
Apple has turned to OpenAI to play catch-up in the generative AI race. The agreement is set to be announced next week at Apple's Worldwide Developers Conference as the tech giant seeks to turn around a revenue slowdown. A Bloomberg technology reporter, Mark Gurman, joins us now for more. Mark, and another great scoop. This is fascinating in terms of a deal that once upon a time would have been unheard of.
It is unheard of for Apple to go with outside partners for core underlying technologies, right? But that's the stakes we're at right now. Apple did a bad job preparing for this AI revolution, this future based on artificial intelligence and Gen AI. They were caught completely flat-footed when ChatGPT hit the market in November of 2022. They were not able to recoup quickly, and they were not able to develop a formidable rival to ChatGPT. What they've done instead is integrate AI deeply into its applications with a very strong privacy story. What's missing, though, is that OpenAI-like functionality. So they were left with a choice: do nothing or partner. And lucky for them, Sam Altman and OpenAI were willing partners, gave them a better deal than they were trying to get, that Google was trying to get in negotiations around Gemini. And so here we are on Monday at the developers conference. Apple announced that OpenAI and ChatGPT is being baked into the next version of the iPhone and iPad operating systems.
And perhaps really a reflection of everything that's going on in the world, the fact that NVIDIA overtook Apple for the first time since 2002, right? I mean, NVIDIA is such a big player in the AI space. What can we expect in terms of this partnership between OpenAI and Apple going forward? Is there something specific that we should be watching out for, which would give us an indication of where the relationship is headed?
So, you know how in Google search or in Safari, you can access Google search. So when you do a web search result, it's powered through Google by default. So OpenAI is essentially going to be the default LLM for the chatbot built into the iPhone and the iPad as part of iOS and iPadOS 18. So if you type something in like, write an email to my wife with suggestions for where we can get dinner in Tokyo, that would be powered by OpenAI rather than Apple's in-house large language models. If you want your phone to develop a photograph of what it thinks the canceled Apple car looks like, something that myself tried to do on ChatGPT and many OpenAI related apps in recent months, that'll also go to OpenAI. You know what's so interesting, actually, that a lot of people haven't really discussed is what's the Microsoft involvement here? Well, let me tell you, OpenAI runs on Azure, right? It's powered by Microsoft infrastructures and data centers and server technology. So this is just as much as a partnership with Microsoft, but in a different sense. So Microsoft will be making some cash on this deal too.
You know, the whole Scarlett Johansson AI voice, there's a lot of concerns around OpenAI, right, and its technologies. But I also do wonder, you've said that this is, you know, not necessarily going to be a long-term or a permanent arrangement. How easy will it be for Apple to get out of this deal when it wants to, have caught up, when consumers will be expecting this to be available as an ongoing piece of technology?
So there's over 2 billion Apple devices, right, in circulation. I would say maybe, I don't know, 20%, 30% of the world uses Apple products. There's, what, 6-7 billion people in the world. You and I care about this Scarlett Johansson situation. Some investors may care about it. People who cover this or watch this closely care about it. I would say 99.9% of iPhone users have never heard of Sam Altman and could not care less who Sam Altman is. They just want their iPhone to have the latest and greatest technology and do what they want it to do. So I don't think the Scarlett Johansson situation, or quite frankly, any of the many controversies that surround Sam Altman, have any impact on this. I quite frankly don't think people care. I think people as a whole just don't care. And so I don't think that's going to have any impact here, as important as those issues are to OpenAI's business and from a financial and Wall Street standpoint. And in terms of getting out of this OpenAI deal, I'm sure they have an annual contract or a 2 or 3 year maximum situation where Apple has an opt-out after, you know, X number of years. Apple has probably language in there that they can replace OpenAI with a better LLM if one approaches down the road, whether that's from Apple or a third-party provider. So in terms of backing out of this deal eventually, I don't expect that to be too difficult.
Our Bloomberg technology reporter Mark Gurman there with another great scoop. Well, Hewlett-Packard Enterprise surging to a record high after sales there beat estimates thanks to strong demand for its AI servers. CEO Antonio Neri says investors are just getting started when it comes to recognising the company's upside in the fast-growing space.
The reality is that we have unique capabilities. When I think about the capabilities HP has in this particular inflection point, AI, number one, we know how to run AI at scale. We have done it for decades. It has been more than a supercomputer now in generative AI. And that comes on the back of our unique expertise in IP, intellectual property. So we know how to build these systems, how to cool it. And then we have a unique manufacturing footprint for water cooling. As we think about the next generation of silicon, we require 100% of liquid cooling. And HP is one of those companies that can do it all. And then last but not least is the services piece. And when you talk about profitability of AI, we think about as a complete pull-through. It's not just the infrastructure side, it's also the services side. And we had a very solid margin performance in our AI systems, which is part of the server segment, where we deliver 18% growth year over year, and we deliver an 11% operating profit. In the guidance, we provide 11 to 13%.
Your CFO talking about prudent cost discipline. Is that what helps with the margin as well, Antonio? Because, look, let's call out JP Morgan, the analysts over there this morning, saying the results in the outlook echoed a similar AI server story of revenue with limited margins. They're not hearing you on the fact that you've got stronger margins.
I think it's a combination of three unique things, Caroline. Number one is prudent business discipline. We have been, on that journey for a long time. We pursue deals that we can add value, that we see path to profitability, and that we can drive pull-through. That's number one. Number two is our complete portfolio. And so one of the key areas that I think the market doesn't understand is that we don't just ship servers. We actually ship the server, we install it, and in many cases, we run it as a part of our HP GreenLake platform. And that includes an enormous amount of services. That's why you see HP GreenLake also growing rapidly. And the fastest growing area of HP GreenLake this past quarter, which grew 39% year over year, is actually AI. And last but not least is our ongoing brutal management of cost across the company. And also we are now deploying AI in our own company.
Hewlett-Packard Enterprise CEO Antonio Neri there. And we have more ahead on the Asia trade. This is Bloomberg.
Boeing's Starliner capsule was finally taking 2 NASA astronauts to space. After years of delays and cost overruns, the craft launched on Wednesday local time, is on track to dock with the International Space Station on Thursday. NASA is using the flight to prove that Starliner can safely carry people to and from the ISS under the agency's commercial crew programs. Shery.
Haidi, staying with space, where so-called space junk is posing a dangerous and expensive problem. Traveling uncontrolled at high speeds, the debris from old rockets and satellites can collide with private and government-owned communications and defense systems worth billions of dollars. Bloomberg's Adrian Wong joins us here in the Tokyo studio with more on this. And Adrian, we've been talking about this for a very long time, but really, how big of a hazard is this?
Yeah, it's a big issue because according to estimates from NASA, there are over 100 million pieces of space debris up there. And you see, with the investment into space, the number of active satellites have actually quintupled over the past 5 years. So when you think about it, the more satellites that are in space, the more problems this is going to cause with the risk of collisions. So you can imagine this kind of like a car crash pileup on a highway, except there are no emergency vehicles to clean up the mess. And so when you think, and so it's not really just a problem in space, because it's also a problem on planet Earth, because these pieces of fragments, they can also survive re-entry into the atmosphere. And when you look at the broader sector, it's not an easy task. Number one, it's super expensive. It can cost millions and even billions of dollars just to remove a piece of space junk. And secondly, there's a big question of ownership as well, because just because there's space debris out there doesn't mean anyone can go get it, because the ownership of the debris is actually on the on whoever actually left it there in the first place. So, which means companies actually need to get permission to retrieve it. So there's been quite a few different options and solutions into this, where we've seen high lasered powered lasers, as well as inflatable bags. But one company I just want to quickly highlight is Astroscale, because they're using quite an interesting method where they're developing spacecraft which actually uses robotic arms to literally grab the space debris. And so it's a really interesting company.
Actually, Adrian Wong, he's explaining to us what's happening with this space. We actually spoke to Nobuo Okada, the founder of Astroscale, so take a listen.
The funds will be put towards research and development as well as working capital, as we did with the previous funding. We're currently demonstrating our rendezvous and proximity operations technology in space. This technology is the foundation for 4 businesses we're developing. The money from the IPO will help us push through our R&D in these areas.
There's still a high level of uncertainty in this business. You yourself are still years away from cleaning space junk. Why is now a good time to invest in Astroscale?
The threat of orbital debris remains unpredictable. That's why it's important to act now. We already know that orbital sustainability will become impossible if we don't tackle the rapidly growing number of satellites, space debris, and junk. That's why we're taking the lead in developing the RPO technology and creating business models. Our work is contributing to creating the global rules.
You've said you want to win business from the private sector, not just governments and space agencies. Why would a private company care enough to pay you to clean up space debris?
We're fielding contracts for projects worldwide, mainly from government agencies. In space, the risks are high, but the rewards are low. That holds true for the private sector, too. We need to turn around the trend. Orbital services can do that. That's why we see a lot of interest from the private sector.
Astroscale founder, president, and CEO Nobuo Okada speaking to Bloomberg's Kurumi Mori. We do have the market opens in Sydney and Tokyo. South Korea away on holidays for Memorial Day. This is Bloomberg. This is the Asia trade. We're counting down to Asia's major market opens. After we saw a little bit more calm in the previous session, Haidi, we had Indian stocks leading those gains across Asia, with Prime Minister Modi being able to form a government with the backing of key allies.
Yeah, and in the meantime, the tech AI trade continues to surge higher and higher. And in fact, we saw the 25th record close for the S&P 500. We're expecting, Shery, that to really play through to some of the tech and AI and chip-related names here in Asia today.
I've been watching South Korea very closely, but it's actually away on holidays. So I'll be watching Japan, of course, at the open. And really that rate differential story also being played in the Japanese yen. Because remember, we have seen the Bank of Canada, the first G7 country to cut rates. We're also expecting the ECB to do the same on Thursday. Right now, we're seeing upside. Take a look at that open of the Nikkei, up 0.9% as the Japanese yen is now holding at around that 155 level. Of course, we had seen significant weakness in the previous session. Remember the pay growth data really pressuring the yen, but overnight in the U.S., we also had the ISM's business activity index, which strengthened the dollar. So we're now sitting close to that 160 level. And of course, we continue to follow the bond space with JGBs, given that the Treasury rally, Haidi, continues.
It does, and we are seeing that really play through when it comes to Australia and New Zealand bonds trading at the moment, really seeing these early gains in this part of the Thursday session on the back of the moves that we see in Treasuries. There's repricing of expectations from the Fed. More data will help to kind of build that narrative, but that is kind of the slight underperformance that we're seeing still compared to that big rally across Treasuries overnight. We're also seeing not too much of a change when it comes to the moves on New Zealand 10-year yields as well. Taking a look at the rest of the markets as we see a little bit of upside, we're expecting some pretty strong gains when it comes to trading in Sydney at the moment. 66.56 is where we're at for trading on the US dollar, so on Aussie traded against the greenback. So we are seeing a little bit of a return to resilience after the losses of the past couple of sessions. Let's get more on the state of the market. Stephanie Uzden, who's the APAC CEO at Deutsche Bank Private Bank, joining us this morning from Singapore. Stephanie, really great to have you with us. So, again, it is another session where we see the poster child, NVIDIA, dominating the trading that we saw in the US. At what point do we expect to see a little bit more breadth in this market, or do you just see further record highs in equities being driven by essentially one company?
Well, you know, we also strongly believe in the trend in AI to continue and being a dominant growth factor for the companies, and you know they are rallying with all the good reasons. Now, of course, we're getting likewise concerned as to how many new highs one can do on a daily basis, but for the time being, I think we're in a good spot. And I think this is also now fueled a little bit by the market coming round to what we are expecting, which is 2 cuts this year. So this is giving the equities market in the US just another push, especially overnight, I think.
What opportunities would you be looking out for in some of these Asian markets, particularly when it comes to that AI secular orientation?
Yeah, well, so we're looking at the tech sector in China. That should be, on that same orientation. We've also seen a stabilization in the South Korea, Taiwan participation around the semiconductor space. So these are all markets that are also, rallying on the back of that. Just coming back to China, of course, the stabilization of the overall sentiment is also helping the tech industry there. And, it's just very recently we've been very tactically, again, going back into the Chinese market as well because of the stabilization measures that really shifted around the sentiment here.
Especially that we're seeing most Asian PMIs also returning to growth. Given the factory data, what other areas across Asia are you liking right now?
Well, we continue to prefer our calls in Japan. Then, these are still en route to do really well. We have seen also that the wage increases that are now coming through into the data is really a theme. So we're liking consumer discretionary in that space. We also like IT and tech. And also the banking industry in particular as sectors in Japan. I already mentioned China. I think India is a long-term opportunity. We had an opportunity now with the correction in the market, and we need to obviously wait until the dust settles a bit. But now that Modi was able to form a coalition, that first part of uncertainty has been out. So difficult to see that, the coalition kind of dynamics would completely derail all the infrastructure investments, all the defense spend, for instance, that is really necessary in that part of the world. So that's still a call we
is Japan also that
about on
rate Is Japan also that rate differential play, and how does India play into that, given that you're talking about Modi as well, because we do have the RBI decision later in the week as well?
Well, interest rate differentials are very much driving the currency. So, and, especially in Japan, I think when we saw intervention for a stronger Japanese yen didn't really yield most probably the expected results, there have now been a focus on potential interest rate increases in Japan to help the currency not devaluate any further. But I think what is happening right now, and I think especially with the Bank of Canada lowering rates overnight, we have the ECB in the G7 space that is expected to lower rates overnight, again insisting on these 2 cuts that the Fed will deliver. That pressure on Asian currencies from interest rates in the G7 space continue to be high or continue to be seen being able to move higher, that is going away at the moment. So that should also relieve some of the pressure on the central banks to do something. And you mentioned the RBI. The RBI will most surely wait and not do anything this Friday because the Fed will have to be the first mover here, not to derail any currency stabilization as well.
Speaking of central banks being under pressure to do something, the PBOC, right? I know you spoke a little bit about China tech, but for broader Chinese equities and risk assets, how much is that hinging on seeing more assertive support from the PBOC? And by extension, if we also see a more resilient US dollar, how much does that play into China plus the rest of Asia EMs coming under pressure?
Well, there's a lot to unpack in your question there. So, one part I see the renminbi being pressured also because the Japanese yen's weakness, of course, is sending signals, and it eats away some of that competitiveness in this high-tech space that both are operating in. But, I look at it from an interest rate perspective. I really look at it from a property sector situation. And we've just saw a lot of measures coming in to stabilize the sector. What is really crucial right now is because the carry for the households is still negative on their property investments and their property holdings. So these interest rates will have to come down eventually. And then, of course, this will also give an impetus to returns in the equities market. However, it's a very fine line to balance for the PBOC because once you start cutting interest rates, you risk that you have a devaluation on the currency side. And sometimes this can be a signal that the market interprets really negatively. So it's a fine line to tread as to when to act. And most probably it would also be good to sync a little bit better with the rest of the world going on a rate cutting cycle eventually.
We've been hearing a lot when it comes to how cheap Chinese stocks look now, given the incredible slump that we've seen in the past year. But at the same time, are we not talking about, say, European equities enough, where valuations also seem to be pretty attractive at a time when we're expecting that ECB cut?
Yes, so we strongly feel that way, not just because I'm sitting here today, I'm working for Deutsche Bank. It is a call that we have on for quite a while, reiterating this, especially now because we see Europe kind of posting a modest recovery and in terms of data, actually, looking quite positive on that side. And on the other side, we will have the ECB, quite firmly starting the interest rate cutting cycle before the Fed, and there will be quite a gap in between as well. So it should be something that gets attention back into European equities, which we feel have been under-owned and undervalued at the same time, especially compared to the US opportunity.
Stephanie Holgen, APEC CIO at Deutsche Bank Private Bank. Good to have you with us with her calls on the broader markets. And of course, we've been focusing a lot on those tech names, especially when it comes to the U.S. market and the Magnificent Seven rally that we saw overnight as well. We'll be watching those tech names across Asia as well. Of course, we do have Korea away on holidays, and Samsung had already seen a big rally, but it will really be that story about AI, the AI space, NVIDIA also just overtaking Apple as well for the first time since 2002, worth more than the iPhone maker.
Just I'm a little bit speechless just looking at these numbers, but of course, time and time again, that outperformance of NVIDIA. Coming up on the Asia trade, though, we get more market analysis with the CEO of Principal Asset Management, here why they're seeing compelling investor opportunities in China. But before that, Narendra Modi securing that coalition deal to stay in power after his party's shock rejection by millions of poor Indian voters. We discuss the implications next. This is Bloomberg. Take a look at some Indian ETFs, of course, which prior to the election results becoming apparent had seen really record inflows, be it you talk about Wisdom Tree or some of the other ones. We are seeing that recovery there. Next fund's Nifty 50 up by just about 1.3% and just a modest gain when it comes to the global India Nifty 50 ETF there as well. It does seem like some of that investor confidence is starting to return. Confidence, or perhaps just a bit of a sigh of relief after we did learn that Indian Prime Minister Narendra Modi has managed to win crucial backing from two key allies in his coalition that allows him to form a government and extend his decade in power. For more, let's bring in our economics reporter, Swati Pandey. And so, you know, there is maybe a sense that investors are seeing through the nuances of this coalition deal. Is he a weakened leader going into this third term?
Yes, he's definitely a weaker leader compared to one that we saw in 2014 and then in 2019. He came with resounding majority in 2019 with 350 seats. And this time his party alone was not even able to make 272, and which is why he has to form these alliances with two parties who are known to jump ships. So it does add to that nervousness. It does add to the challenge for him to enact some of the ambitious reforms around land or labor laws. So he is definitely a weaker leader, and it will be interesting to see these coming 5 years.
So tell us a little bit about those implications for land and labor reforms and what that would actually mean for the Indian economy, which we have to put it into perspective, is still one of the fastest growing major economies in the world.
Shery, look, that is not going to change. So India will continue to be one of the fastest economies in the world. That India growth story is going to be intact. And Modi is likely to keep pursuing those business-friendly policies. So those things are likely to be the same, and probably which is why we are seeing the market rebounding from hitting those lows the day before. And there are going to be struggles in a coalition, but then coalition governments have been the norm in India for years and years, and they have been actually credited with some of big reforms, including the opening of India in the 1990s. So it's not all downbeat. And the other thing is, in terms of India's position in the world, that is also unlikely to change, with US continuing to quote India as a critical counterweight to China, and India will also continue to maintain its strategic independence. So those things are also unlikely to change.
Does it have implications for the fiscal path? You spoke about the difficulties for economic reforms in some ways, and we also know that for in certain parts of Modi and the BJP's agenda that's really core to their agenda, these partners don't necessarily see things on the same page.
That is right. So Modi has a very pro-Hindu agenda, which the other alliance partners don't, and which is why Modi will probably have to do some populist measures which could increase fiscal spending, and it's not clear what those alliance partners have asked for. They may ask for key ministerial positions, or they may ask for something that Modi needs to do for their electorate, for their people, and those could move him from the fiscal plans that Modi has at the moment.
Our economics reporter Swati Pandey there with the latest on India. We do have much more ahead here on the Asia Trade. This is Bloomberg.
There are people that depended on a low-rate environment to get exits. And I don't think that low-rate environment's coming back anytime soon. I think rates will probably come down from here, but we are in this environment for some time. I think that's a good thing. Some of the businesses that relied too much on unprofitable growth are going to have challenges getting exits, frankly, at any price, at any time.
Valuation environment has fundamentally changed, and as a result, private equity sponsors are just going to have to hold companies longer, have to grow into those capital structures, are going to need to take on equity to get some refinancings done. And all that means, it's just math, that returns are going to be lower over the next few years.
Investors look at their DPI multiples, how much money has been distributed. So I think there is a backlog of transactions that were supposed to happen in the last 12 to 18 months that have been delayed, but they are coming, and we're seeing that in the pipeline today.
You're seeing deal activity come back, certainly over a lower base from last year. And our view is that that's going to pick up over the course of this year into next year, simply because limited partners in private equity want to see their capital back.
In general, just the need for this type of capital is insatiable.
Bloomberg TV guests at the Super Return International Conference in Berlin. Let's now get to some of the market calls that we're following today. Goldman Sachs, now its trading desk, seeing a wall of money pouring into the stock market in early July. The bank's Global Markets Division Managing Director Scott Rubner saying that may set up a continuing rally in the next quarter and into the second half of the year. He adds that share prices should benefit from strong seasonal trends and also rising engagement from retail investors. Now take a look at what Apollo Global Management is also saying. The private equity industry must face up to the reality of lower valuations. Co-president Scott Kleinman saying there will be fewer realizations and lower returns on the horizon. He explains that private equity firms will eventually have to refinance assets, Haidi, that they bought up until 2022 at higher rates.
Shery, also watching energy markets with Saudi Aramco lowering prices for all of its oil to Asia next month. This is the first reduction since February. A pricing sheet says that flagship Arab light crude will be cut by 50 cents to $2.40 a barrel above the regional benchmark. If it comes, or it comes, in fact, after some OPEC Plus members, including Saudi Arabia, agreed to gradually roll back voluntary supply cutbacks starting in October. And oil is actually holding up a little bit of strength. We are seeing this effect of traders really trying to find a price floor after so much deterioration when it comes to that demand side expectation, as well as return potentially of more supply as well. We are seeing a bit more of a recovery across industrial metals, copper falling at one point through that 10,000 level after the recent hefty gains, but we are now starting to see a bit of a stabilization there as well. Gold prices are in focus as we continue really to watch for what the Fed might do in light of the recent data. We've seen that rise in precious metals, that focus shifting again for that Fed rate path there as well. The US services sector data seeing that expansion by the most in 9 months on Wednesday. We are seeing bullion just pairing most of Tuesday's decline with that broader sell-off that we saw in commodities. We did get that record surge in gold, but pretty range-bound at the minute. Let's check in on how.
And Haidi, we are getting, of course. Let's turn to the rally that we're seeing in European stocks, Haidi, because it really is about the broader markets, right? We have seen the ASML holding stock really boosting the tech sector across Europe as well, in expectations that the ECB will cut rates, and that's been really driving positive sentiment. Let's talk a little bit about what we're expecting from the European Central Bank, because we are seeing now rapid wage growth and surprisingly robust Eurozone output. And that's really pushing some analysts to waver in their expectations that the ECB will cut interest rates on Thursday. Let's bring in executive editor for Asia Markets, Paul Dobson. Paul, so the expectation still for a 25 basis point cut, but there is still some skepticism that they might be able to pull it off.
Well, good morning, Shery. I think the cut for this week is pretty much nailed on. The ECB has telegraphed it very clearly. The question is really about how many more rates or how many more cuts we will see to the interest rate for the rest of the year. The analyst community is looking for 3. The market is only pricing in 2, so not a lot of confidence overall. I should clarify, the market is pricing in 2 cuts, including this one, and analysts are looking at 3 overall, including this one. So, you know, the question that people will be looking for from Christine Lagarde and from the ECB is, how soon could another cut come? Some of the policymakers would like it even to be on the table at the following meeting, although it seems like there isn't a consensus around that view at the moment. Maybe after the summer would be the timing for the next one, and maybe looking at moving on a kind of quarterly basis from then. But bond yields and the rates market are not that confident that the ECB will be able to deliver that many cuts, partly because the inflation still looks a little bit sticky and has been surprising to the upside recently, and partly just those concerns about how far ahead of the Fed the ECB can get and how wide an interest rate gap it wants to open up. Because remember, the more that it does that, the more we see pressure on the euro, and the more that would be an inflationary factor for European markets.
We've seen euro-dollar pretty much range-bound for about a year and a half, right? Could we see a revival of volatility as a result of this? And I guess the implications for Asian FX?
Yeah, it's a good question, and you're right. It has been pretty stable, and there hasn't been a great deal of volatility in FX markets recently. Partly, I think that's because of the anchors that have been laid down in the rest of the world, particularly, China holding the yuan very steady at the moment, India, for that matter, also keeping the rupee pretty range-bound despite the volatility this week. I think what people will be looking for is, will the ECB deliver on the dovish side? If Lagarde comes across as hawkish, or if the statement seems pretty hawkish, then one thing that we should watch out for is euro-yen. And whether the euro can rise to an all-time high against the yen, which isn't that far off. So maybe you would get some propulsion there, just because, as we know, Japan has much, much lower interest rates than the rest of the world, and that pressure on the currency there remains as a result.
And really, when it comes to the Fed next week as well, not necessarily a lot of expectations in terms of actions, but it's really the economic projections that we're watching, right, in all of these central banks. What are you focusing on? Yeah, for the Fed, I guess the market is back to pricing in 2 cuts for the year, but only in November and December. I guess we will want to know what the Fed's latest view on the economic data has been. There's been some signs of a slowdown in the numbers recently, not just in jobs and inflation, but also in consumer spending in the housing market as well. So I guess one concern is how quickly the economic picture is deteriorating. What does the Fed think about that? One of the other things that the Fed has been pointing to has been the labour market and how it's watching for signs of a turnaround there, which might give it more confidence to cut interest rates as well. So it will be talking about those kinds of things as well as the inflation outlook, which will give us a clearer view of how minded to a shift towards interest rate cuts they could be. But remember, last meeting, in the minutes, it came across quite clearly that there was a discussion about potential hikes as well. So again, it will be a question of kind of, where do they tread that line, and how confident are they in cutting later in the year?
Executive Editor for Asia Markets, Paul Dobson there. You can, of course, follow more on the story, all the day's trading action on our Markets Live blog. That's on the Bloomberg at MLIV Go. You can run down the analysis, the commentary from our team of expert editors. This is Bloomberg. We are just about 30 minutes into the Asia trade. The top stories you should know today. Asian stocks are gaining following that tech-fueled rally in the US. The S&P 500 notching its 25th record close this year, with AI and poster child NVIDIA leading the way after hitting $3 trillion in market value. The Bank of Canada is the first G7 central bank to launch into an easing cycle after lowering its benchmark overnight rate by 25 basis points. The ECB is poised to follow suit later on Thursday, with analysts also pricing in a 0.25 percentage point cut. And Narendra Modi has secured coalition support, handing him a third term as India's Prime Minister despite his election setback. India's stocks rebounded yesterday from the post-election rout that had raised almost $400 billion in market value. take a look at how we're trading across this Asian session. Of course, South Korea is away on holiday and is therefore not benefiting from this NVIDIA and AI tech-related surge that we saw overnight. We are seeing broad upside, though. The Nikkei 225 up by just about 1 and about 0.25%. We are also seeing a little bit of upside there when it comes to trading in Sydney, just about half an hour into the start after US shares, of course, saw another record high. Shery.
Heidi, let's bring in our next guest who says countries such as India and Japan have been benefiting from the China plus one strategy as investors are looking elsewhere to park their money amid escalating U.S.-China tensions. Joining us now is Kamal Bhatia, President and CEO at Principal Asset Management. Kamal, great to have you with us. I mean, these geopolitical tensions are not expected to go anywhere, but we have seen already such a run-up when it comes to Japanese and Indian equities. How much further could we go?
Good morning, Shery and Haidi. Good to see you from Hong Kong. I think you raised a good question with respect to valuation. So I would say India is definitely a highly valued market. And while Japanese equities may be fairly valued, I think longer term, they are essentially the markets to be in. And as you brought up, I would say they are definitely benefiting from being the new China with respect to investor interest and where you see both growth and breadth in the marketplace.
But you don't necessarily think that you should leave China altogether, right? Is it a China plus India plus Japan strategy for you?
It's a great question. So we as a long-term investor have a view around all three markets. So China definitely from a valuation perspective has been becoming much more interesting. But the challenge with China tends to be right now is at a macro level, there is a caution. At a micro level, there's a little bit more optimism. I think India, as I said, is highly valued, but longer term, it will continue to be the growth market for investors. And for long-term investors, that is quite intriguing. And then Japan really adds a different dimension for us, which is it is the market with the largest breadth. And definitely recently, the changes with respect to shareholders, with respect to both activism and how they are treating both domestic and international shareholders for someone like us is very, very valuable. We manage over $710 billion globally. And so for us, all three markets have value, but in a different way to our portfolios.
And you present, of course, this coming off another session where we saw NVIDIA driving the bulk of the gains. And you rightly point out there are real risks and opportunities with AI, right? How do you balance those risks in terms of how you potentially invest around them and the visibility over the use cases, not just at this stage, but the next stages as the tech develops?
Absolutely, Heidi. So I think what is different about this cycle with technology and particularly AI at the center of it is this is really a cycle about hardware. And effectively, it's about the ecosystem of hardware, whether you look at the chip companies, but also just the industrial CapEx development that will go around with it. We are a big investor in real estate, so that's certainly an area we think about, which is very different than the prior technology cycle, which was very software-centric. So in our view, it's really important to kind of think about the hardware requirements that the AI cycle is bringing upon us. And if you have that lens, going back to your earlier question about Asia, clearly hardware has been an epicenter of development in Asia. In the prior internet boom, outside of China, there wasn't really a whole lot of software innovation that happened in Asia. But definitely with this cycle, you certainly hear a lot about Taiwan. But if you look at a place like Japan and even Korea, there's a lot more interesting companies that are going to be playing this AI theme.
You talk about the potential inflationary impact that perhaps maybe we are not talking enough about arising from geopolitical uncertainties as well, right? What are you watching out for as we get into November, US elections, but also some of the other uncertainties and geostrategic divergences that we see around the world?
It's a great question. So I would say it's always tough to predict politics, and we certainly don't do that from our seat, but we do pay attention to a lot of macro drivers. And I would say geopolitics is certainly playing into how interest rate are behaving all across the world, certainly from a risk premia perspective. From our seat, we do look at U.S. as our primary core market, and certainly that continues to be, from a growth trajectory, on the right path. Certainly it has become more important to look beyond the growth companies in U.S., and we certainly see value there. But to your question on geopolitics, I would say Asia gets a lot of attention, but it is still a very good market to invest in for a growth investor, despite those risks that exist in the marketplace.
And let's talk a little bit more about the U.S. So how do you hedge the elections, and do you have a base case at this point?
Our base case is mostly around what it means for GDP growth and interest rate policy. And our view continues to be, irrespective of the results, I think the growth in U.S., while softening in the short term, is still above trend line and will continue to stay that way, which will certainly drive interest rate policy, which drives a lot of the investor returns in the U.S. marketplace. We're certainly not worried about the impact of elections, certainly on the direction of travel for the U.S. marketplace. And in particular, we are big investors in small cap and mid cap companies in the United States, and I do believe they will certainly benefit as we enter this next cycle over the next 12 to 18 months.
We've heard some economists talk about how if it was up to them, the Fed would just move this month, next week, given that as we get closer to the election, there might be more political risk around a Fed decision around rate cuts. What's your view about what the Fed can do at this point and going into next year?
Our view remains the Fed is fairly independent and will probably stay that way. I think one of the things their challenge remains is they are much more focused on data now. They have been very vocal about their data dependency, and they've expanded the toolkit of the data they are looking at. And the data in U.S. certainly is a little bit mixed. Certain data points would tell you the economy is weakening, and other data points continue to point in the direction of employment still being strong at times. And so I think the Fed's challenge is as they become more data dependent and they continue to look at more and more data points very acutely, they're not getting a clear signal in which direction to move in. So I certainly think that's causing a little bit more volatility in the U.S. markets with respect to where they want to be and what the market is interpreting their actions to be.
Kamal Bhatia, good to get your insight. CEO at Principal Asset Management, joining us today from Hong Kong. Take a look at some of the big movers in the Tokyo market right now. We're seeing SoftBank seeing one of the biggest gains in almost a month. Now we're hearing from people familiar with this matter that activist investor Elliott Investment Management has built a sizable stake in SoftBank Group and is now pushing the Japanese company to launch a $15 billion buyback. We are now seeing SoftBank rallying at the moment as we're seeing perhaps a little bit more pressure when it comes to automakers. Of course, we are watching Suzuki Motor, which is slightly higher by 0.4%. Local media now reporting that Japan has started an on-site inspection of Suzuki Motor as we continue to see an emerging scandal over 5 Japanese auto manufacturers when it comes to wrongdoing in its certification process. Still ahead on the Asia trade, the Chinese EV maker NIO and food delivery giant Meituan both reporting their earnings later Thursday. We'll preview those results next. This is Bloomberg.
Chinese EV maker NIO dropping its first quarter earnings later on Thursday. Bloomberg Intelligence is forecasting only an incremental rise in revenue. Our Asia transport reporter Linda Liu joins us now. So what are these expectations?
Yeah, as you said, revenues are probably going to be flat or a very small increase. This is due to deliveries actually decreasing in the first quarter. And we're also expecting an operating loss to have widened compared to last year because NIO's had to really turn to sales, marketing expenses and discounting to maintain the sales momentum. Gross margin for automotive hopefully will be be high single digits, but it's falling behind its peers like XPeng and Tesla, which is pulling in double-digit automotive gross margin.
We're hearing that NIO's order intake is starting to pick up. What else can they do really to push sales going forward?
Yeah, so after that first quarter, when they suffered a sales decline, in April they launched this 1 billion yuan trade-in incentive program, essentially try to entice customers that have gasoline vehicles to come and trade it in for a NIO EV. So we're starting to see effect from that program already. In May, their sales surged by something like more than double. So hopefully with this discounting and incentive program, their sales momentum can continue.
The new Onvo brand, is that likely to make a difference?
Yeah, NIO is quite excited about this new Onvo brand that they've just launched. It's going to be a mass market brand that's going to be more affordable than the existing lineup. The first car from the Onvo brand is going to be a model that's directly competing against Tesla's Model Y. It's going to be about 20,000 yuan cheaper. And so NIO has really high expectations for this brand to pull in even more volumes. And they're pretty confident about market demand. We've seen other media report that NIO is planning a third factory. So their future outlooks is they're expecting to be pretty good.
Our Asia Transport reporter Linda Liu there with the latest on what to expect from NIO. And in fact, we do have more earnings coming up. Food delivery giant Meituan also reporting later today. Analysts expecting growth to take a hit from rising competition and volatile Chinese consumer spending. Bloomberg Intelligence says Meituan could announce a new share buyback program after using up most of its current billion-dollar budget. For more, senior Asia-Pacific consumer analyst Catherine Lim joins us now. Catherine, so the market seems to be expecting slower revenue growth for Meituan this year. Should we be concerned about this?
Well, do you know what? It was a great 2023 for Meituan after the reopening of China. We've actually seen, the rise in outdoor activities. Travel was a big one for them last year. And clearly the momentum, while still very healthy, it will be slowing, from a bigger base. So, that is what we will likely be seeing from Meituan this year. But bear in mind that it is still going to be a double-digit revenue growth for the delivery as well as local services company. So, things are still looking fairly healthy for the company, if you ask me.
We have seen, of course, intense price competition in e-commerce in China. Does that extend to local businesses, local service businesses that Meituan obviously is in?
Right, well, definitely. In China, if there's no competition, that wouldn't be China, really, isn't it? So we've actually continued to see, competitors like Douyin, even Tencent's videos accounts, just starting to actually offer, those local services options, on their platforms. That's kind of like giving Meituan a little bit of a run. And really, consumers now have more options to actually have to make their food delivery orders, or even to actually go into buying travel tickets. So that's where the competition is coming in. And that's what you will likely be seeing from Meituan, whereby they continue to actually invest into the perks for users to retain existing users.
Bloomberg Intelligence Senior Asia Pacific Consumer Analyst Catherine Lim there. We have more ahead on the Asia trade. This is Bloomberg. More chipmakers are looking to Southeast Asia as a location for new facilities. A Dutch manufacturer and a TSMC-backed firm have just announced a deal to invest nearly $8 billion in Singapore. Our tech reporter Annabelle Jewellers joins us now with the details. So, Belle, this is really about diversification, particularly in such a politically volatile time.
Yeah, that's right. We speak so much about that China plus one strategy. You're either looking at shifting operations away from China, or you're just looking to invest directly into economies that are perhaps more stable from that geopolitical perspective. And Southeast Asia is really the key beneficiary in this because it's got low labour costs, or relatively low labour costs, a lot of tech talent, close to major consumer markets as well. But this is that latest iteration of China plus one. The deal that you mentioned there is between the Dutch chipmaker NXP, like you mentioned, also Vanguard as well, which I was just taking a look earlier at the ownership structure. It's just under 30% owned by TSMC, so very much the biggest shareholder there. But the investment, as you said, just under that $8 billion mark, so $7.8 billion, and it's going to be about building new chip wafers, not perhaps the most technologically advanced chips out there, but they're still really important for things like powering, controlling cars and mobile devices as well.
And Belle, this is not the first time that these companies have actually teamed up in Singapore.
Yeah, and that's one of the reasons that we heard, for instance, from the CEO of NXP earlier, talking about why they chose again to take this route in Singapore in particular, because actually NXP had a joint venture with TSMC that started back at the end of the 90s when it was still under the Philips brand. So yes, as you said, that was part of that decision. But what is important to note as well is that this new facility is actually going to have the most cutting-edge technology. So what Vanguard's, for instance, doing right now in Singapore, they're producing chip wafers that are 8 inches in diameter. This one's going to be 12 inches in diameter, so about 30 centimetres. So you're basically putting more chip output per wafer.
You know, tiny but mighty, that's the Singapore economy, right? But there is so much focus on future-proofing this reputation. This is a bit of a coup for the new leader, Lawrence Wong.
Yeah, well, as we're discussing, Lawrence Wong has just taken leadership there, new Prime Minister, and a lot of different challenges that are on his plate. He's got things like a cost of living crisis, he's got geopolitical challenges, but also really stiff competition within the region here, within Southeast Asia. And you take a look at semiconductors in particular, they're a really key part of Singapore's exports. And just last week, actually, when I was in Singapore, I was speaking with the Senior Minister of State about why the country has a distinct competitive advantage, things like a well-trained workforce, a good supporting ecosystem, but there are still competitors. And Malaysia, of course, is just over the border, and we've seen a lot of investment going into Johor, in particular from the likes of Nvidia, Intel as well, a ByteDance-owned company, and as well in Malaysia looking to put about $5 billion into attracting chip designers. But Malaysia, Vietnam, Thailand, they're really all looking for the same sort of investment here, Shery.
Annabelle Jewelers there joining us from Hong Kong. And one stock that we're watching right now in Tokyo trading, Astroscale. Take a look at that huge plunge at one point down more than 10%. And this, of course, after surging in their Tokyo debut. Now, this company is developing spacecraft to remove space junk, not to mention trying to offer services to refuel and repair satellites. Founder Nobu Okada spoke to Bloomberg about their plans for the company.
The funds will be put towards research and development as well as working capital, as we did with the previous funding. We're currently demonstrating our rendezvous and proximity operations technology in space. This technology is the foundation for 4 businesses we're developing. The money from the IPO will help us push through our R&D in these areas.
There's still a high level of uncertainty in this business. You yourself are still years away from cleaning space junk. Why is now a good time to invest in Astroscale?
The threat of orbital debris remains unpredictable. That's why it's important to act now. We already know that orbital sustainability will become impossible if we don't tackle the rapidly growing number of satellites, space debris, and junk. That's why we're taking the lead in developing the RPO technology and creating business models. Our work is contributing to creating the global rules.
You've said you want to win business from the private sector, not just governments and space agencies. Why would a private company care enough to pay you to clean up space debris?
We're fielding contracts for projects worldwide, mainly from government agencies. In space, the risks are high, but the rewards are low. That holds true for the private sector, too. We need to turn around the trend. Orbital services can do that. That's why we see a lot of interest from the private sector.
as we wait for updates on the Audrey mission, what's your next milestone?
So, the 4 business areas I mentioned earlier, they are end-of-life services for retired spacecraft, life extension and inspection of satellites, and active removal of debris. Our next big step is to demonstrate the value of these space capabilities to the clients in the fiscal year 2028.
And why are you so passionate about solving this problem of space debris?
11年前にこのスペースデブリ問題を知りまして
When I first heard about the space debris problem 11 years ago, I started this project immediately. Back then, nobody had a solution. I saw a good business opportunity, but I also felt a sense of duty, that someone had to solve this environmental problem. I considered this venture as my final gig in life.
What are your hopes for this IPO and this stock now?
The issue of space sustainability has become a truly global and urgent one. There's no time to waste. I hope to see many take an interest in the issue of space debris and the environment.
That was the Astroscale founder, president and CEO Nobu Okada speaking to Bloomberg's Kurumi Mori. Take a look at some of the stocks that we're watching where markets open in Hong Kong and mainland China. We'll be watching, of course, Asia chipmakers after the news that TSMC-backed Vanguard is teaming up with NXP to build an almost $8 billion plant in Singapore, and of course on the back of another big session for Nvidia, cracking that $3 trillion market cap. Chinese solar firms, including LONGi Green Energy and Technology, are halting production at their Southeast Asian factories as increased US curbs create more uncertainty there. Big day for Chinese earnings, as we've been talking about Meituan and NIO, both set to report. Shery.
Yeah, take a look at how we're setting up for that open. Chinese futures at the moment, in the last close, we had it gaining 0.1% after losses in the previous session for the CSI 300. And when it comes to U.S. futures, really not doing much at the moment. Of course, we had that huge rally in tech stocks with the Magnificent Seven leading those gains. Coming up in the next hour, more market analysis with HSBC Asset Management's global chief strategist. We discuss their investment strategies and why they're seeing improving investor sentiment in China. That's it from the Asia Trade. The China Show is next. This is Bloomberg.